Hello and welcome to this month's episode of Third Thursday 30, the monthly program that's dedicated to providing you the information and insight necessary so that you can live your life the way that you want to and make the most out of your money. So, while many other advisors are out there telling you that you need to save more, you know our job here is to make sure that your money is serving your life the way you want it to. And we're going to give you information all in 30 minutes or less. So the topic of today's conversation is self-directed IRAs and alternative investments. As you know, if you've listened to me before, that a good amount of my energy is spent trying to prevent people from making mistakes, and I have a lot of hard things to say about many people in the industry. And as you know, not only do I have the financial advisory firm that we try to protect people, but I also have the legal firm where we do sue people when they do bad by investors. And part of the reason why I do this is because I've found over my years that there are too many people out there that are not trustworthy. The fellow I'm going to talk to you today, I'm glad to say, is not only a friend of mine, but is one of the good guys in the industry. We're going to have a conversation today with Kirk Chisolm. Kirk is a financial advisor out of Massachusetts. He has been in the industry for more than 20 years. And like myself, he is one of the people that are out there that focus more on making sure that your money is working the way that you want it to, as opposed to being somebody that is trying to pigeonhole you into things that are not just quote unquote suitable for you. So without further ado, I am going to introduce you all to Kirk Chisolm. Kirk, welcome.
Hey, how's it going, Greg?
It is going real well. So Kirk, as you heard, I told everybody about you and who you are and what you do. And what we are going to talk about today is just one sliver of what you do in your business, which is the self-directed IRA space. As the clients should know, or the people listening should know, that Kirk also is a media figure. He has his own podcast, the Money Tree Investing Podcast. Is that correct, Kirk?
That's correct, yeah. One of the longest running financial podcasts out there.
Congratulations. So if somebody wanted to join you on your podcast, how would they go about doing that?
They could just go to moneytreepodcast.com and learn more about us there. That's, we've been around for a while, so we're pretty easy to find.
How often are those episodes being put out?
Once a week. So we have a weekly show. We bring on guests of different aspects, things along the lines of like what we do, alternatives. We bring on some pretty big guests once in a while. But really, it's just the show is to focus on trying to get the best investment advice for people that they can get on various topics, anywhere from personal finance to investing. We have a lot of people are interested in real estate. We talk about real estate a lot. That's pretty interesting because we bring on some guests that are really in the trenches. So people who are doing fix and flips, rehabs, things like that. But it's really supposed to be kind of more of a well-rounded podcast. And we have a panel at the end where we talk about the topic from some people who are experts and some people who aren't. But we just get different points of view so people get a well-rounded view of the idea, not just one person's.
Well, for you listening out there, you know my job is to get you information, and I can only do this once a month. So, Kirk, kudos to you for doing it weekly. And I would suggest if anybody is listening to the program today and values this type of information, you should go ahead and get yourself hooked up with Kirk's podcast and listen to what he has to say on a more frequent basis. So, Kirk, the primary conversation today was going to focus around self-directed IRAs. Can you explain to our audience exactly what is a self-directed IRA and why that may be something that they would want to know about?
Sure. So self-directed IRAs is kind of interesting. So a lot of people think self-directed IRAs are different, that they're somehow different from regular IRAs. But the reality is self-directed IRAs are pretty much the same as a traditional IRA that you're finding. So every single IRA is self-directed. Now, the difference is if you go to like a Fidelity, a Schwab, a TD Ameritrade, if that's where you have your brokerage account, you can get an IRA there. And when people refer to self-directed IRAs, the terminology is really used to describe an IRA that can invest outside of the stock market. So things like real estate, horses, tax liens, private company stock, virtually anything can be invested inside of an IRA. But these custodians that you use for your stocks, bonds, and mutual funds, they're capable of offering this, but they don't. So it's really up to them to put in their own parameters of what they allow and what they don't allow. And the reason that they don't do it is because they're not equipped for it. So some custodians, like a Fidelity, a Schwab, they're really, really good at stocks, bonds, and mutual funds. That's what their bread and butter is. They're very well equipped for that. But if you go up to them and say, hey, I want to invest in a horse with my IRA, they'll just tell you can't do it. And what they mean is not that you can't do it, what they mean is they can't do it. So there are about 47 custodians and administrators out there that do specialize in these alternatives, and that would be the kind of custodian you would have to use if you wanted to invest. So from an IRA perspective, really it's about figuring out what you want to invest in, and then from there figuring out the best custodian to house that asset.
So I first became aware of self-directed IRAs early on in my law practice. I had a client that had some farmland that they were looking at, wanted to know what they could do with, and they were looking at doing a self-directed IRA. They had heard about it somewhere else. And back then I didn't know Kirk Chisolm, so I didn't know who to go to, but this was 15 odd years ago. And I really had no benchmark for what to look for in a custodian for that. Do you have any guidelines that you would suggest people think about if they are looking at using a self-directed IRA to hold, for example, some real estate that they're trying to develop or something like that?
That's actually a great question, because most people, they do a bare minimum amount of due diligence on their custodian. So they go to a website, they say, hey, who's the best custodian? And somebody gives them a name, and they just go and choose them. The reality is there are 47 of them. Now, when you're looking at the stocks, bonds, and mutual funds, like the Fidelities, the Schwabs, the TDs, they're virtually identical. Like, you're going to get similar service, similar fees, similar systems with all of them, because they've found the most efficient way to do things. When you're working with a custodian that deals with alternative investments, it's different, because not all of them will work with everything. So real estate is the most common asset held in self-directed IRAs, but not all of them allow real estate. Some of them allow cryptocurrencies and some don't. Some allow private company stock or single member LLCs and some don't. So that's one of the criteria. You have to make sure that the custodian actually will hold the asset that you want to own. Another part is fees. You'd say, like, if you're buying a stock, they're all charging $5 a trade now. Like, that's the industry standard. That's the low bar that they've set for themselves. With these alternative custodians, their pricing models differ wildly. Some are transaction-based, some are more fee-based, some are a hybrid. They really, they're all different. And you have to find a custodian that the fees are going to line up with the type of transaction that you're doing. So if you're doing one transaction and you're not going to make a change for 10 years, then transactional might be the most cost effective. But if you're flipping properties every other week, transactional is going to end up costing you a lot of money. So you need to find one that's more based on the amount of assets you have rather than the amount of transactions. So you really have to kind of think through what you're going to be doing with this account and come up with the most cost-effective way. Now, we wrote a blog post about this a few years ago. There's like 100 criteria that we look at when we look at custodians, so we do a deep dive on all of them. And we've done actually a good amount of industry research, which is publicly available on our website that you can find. Partly because this is one of the most commonly asked questions. There's not a lot of good research out there. There's not a lot of unbiased research. There's no unbiased research out there, which is why we did it, because everything you read is kind of a puff piece, right? They want more business. Hey, here's a good, this custodian's the best. Well, great. Well, how much did you charge them to say that? You know? So it's really hard finding a good custodian that lines up if you don't do your own research. But there are a lot of great custodians out there. You just have to put in the time.
So it sounds like you've kind of have two different categories of assets that we might want to be looking at in a self-directed way. Your traditional kind of investments. I'm managing my own portfolio, and you have your non-traditional or alternative investments, such as the LLCs and things of that nature you talked about. So, first of all, is it common or uncommon to find a custodian that serves both purposes well?
Great question. No. So this is the holy grail, and I think the custodians that deal with traditional assets do it really well, and the systems they've designed work really well for them. But for the alternative custodians, they have very different systems. And while some of them offer traditional investments, they do that through the other ones. So we've tried to scale this, and the best we can come up with is we just have two different custodians for some of our clients. We have some for alternatives and some for traditional. We have not found an all-in-one solution. Maybe at some point some company will get there, but for right now, no one has cracked that code.
So if we are managing our own portfolio and we want to do options trading, those kind of things, to the extent that we're not doing anything really out on the edge, then some of these more traditional name brand kind of custodians may be an appropriate solution. Does that sound correct?
Well, I think if you have are you talking about the alternative custodians?
No. Well, I want to categorize. If I've got a client that wants to do options trading, they don't necessarily need to go to some of the alternative custodians, but rather the more traditional custodians for that type of a self-directed IRA. Am I correct on that?
Correct. So Schwab, Fidelity, and TD, and there are more. I'm just using these repeatedly, but they're all equipped to deal with options, which we do a lot of. But they're really well equipped for that.
So then, when we talk about the more non-traditional type of assets, you've mentioned a couple of them. I just kind of want to walk back through them. Some of them are more glamorous than others. You mentioned land is something that can be held in a self-directed IRA. You mentioned horses, which was curious, and we'll go back to that in a second. Bitcoin and that kind of fun stuff. And then small LLC type of interest.
Yep.
I imagine that people have tried to get very creative about trying to use these type of self-directed things and still have present benefit of that type of stuff. And I also imagine that that's a no-no. Can you kind of give some parameters on that?
Sure. So there's two parts to your question. The first part is how creative you can be with these type of transactions, which is quite creative, and the more creative, the more benefit you can get. The other part of your question, I think you're asking, is what are the challenges? What are the things you can't do, right?
Yeah.
So there's part of this which is you can create what they're called prohibited transactions. Now, a prohibited transaction is something that will effectively cause your IRA investment to be invalidated, or effectively it would be distributed. So one of these transactions is you can't do business with a disqualified person. A disqualified person would be yourself, your spouse, your kids, grandkids, your parents, grandparents, anyone who's of lineal ascent or descent. Those are disqualified people. So for instance, let's say you bought a piece of real estate in your IRA and you rented it out to your mother. That would be a disqualified that would be a prohibited transaction. Let's say you rented it to someone you didn't know, but their toilet broke and you went and fixed it as a landlord. that would be a prohibited transaction. So you cannot give any benefit to your IRA, and your IRA cannot give any benefit to you. And that benefit is not necessarily monetary. Sometimes it is what we would call sweat equity. So fixing the roof, you can't fix the roof of your house. You can hire somebody. You can do what we would call settler functions, which is you could administrate. You could hire people. You can pick the property. You can pick the property manager. You can pay the bills. You just can't do any actual work on it. So this is the problem for most real estate investors because most of them are do-it-yourselfers. They're people who scrape every nickel and dime. They're asset-rich, cash flow poor. It's just generally how most real estate investors are. But they're very thrifty with their dollars. And that becomes really challenging with IRAs because you can't do it yourself to save money.
So if I'm understanding correctly, Kirk,
things that can become challenging. And depending on the transaction, prohibited transactions will vary based on what type of asset you're looking at.
So I want to summarize
now the other
that.
side of it is, go ahead.
Yeah, I want to summarize that just because that seems to be a very important point for people to understand. So although it may sound very enticing to try to build your real estate portfolio in a self-directed IRA and doing the flipping type of investment, what you're saying is if you are going to do that, you can't put elbow grease into it. You got to be basically an absentee, writing checks and leveraging it that way, but not using your own sweat equity.
That's exactly right. Yeah. Yeah, and it's a challenge because some people have a hard time doing that. But what we find is there's a percentage of people that come to us who want to circumvent the rules. And I'll tell you flat out, don't do it. If you think you're smarter than the IRS, you're not. And I've seen way too much. I know how they operate. We usually are brought in to try to correct problem transactions. So somebody will have created a prohibited transaction. And there are occasions where we can come in and correct it. Not always. Sometimes it's not possible. But there are circumstances where it is possible to correct it and to fix it. And at any given time, we're usually working on a few of those, at any given time you talk to us. But it's what I've seen in some scenarios, and I'll give you the reason why you don't want to mess around with this. So we dealt with a guy who was, I won't tell you the asset because I might give it away because there aren't many people doing it, but it was an interesting asset and very legitimate, straight up guy, always crossed his teeth, dotted his I's, he did everything right. But for whatever reason, he chose a custodian that wasn't a custodian. He chose a person who said they were a custodian, but they weren't. And the reason that they found out this individual we were working with, the reason they found him is because they found this guy. He was basically defrauding people, saying he was a custodian and wasn't. And so after they got him, the IRS said, oh, look at your client list. Look at all of the people that have broken the rules. Inadvertently, obviously, but they don't care. They just want their money. So they took him to court, and I think he had somewhere like $10 million or something in his retirement account because of the investments he was doing. And it wiped it all out. He had nothing left. Because the problem isn't that you create a prohibited transaction. Because let's say you have $1 million, you invest in real estate, and you live there. You didn't know the rule, and you live there, and you realize, oh, I messed up. Well, that money would be immediately distributed, right? So you pay your taxes, you pay the penalty, and that's okay, right? So you have to pay your 30, 40% or whatever it is, and that's fine, right? You can recover from that. What's not okay is the fact that the IRS finds this out 6, 10 years later. With the interest and the penalties and the accruals, you're going to have nothing left at the end of that period. So the issue is not where they find you. The issue is that they never find you right away. They find you like years and years later. And by then, you should have taken the distribution 10 years ago. Well, all of that adds up, and that's where really the problems come in.
Wow. So, I know one of the things that you like to say is using self-directed IRAs is a way that you might be able to invest in your passion. What do you mean by that?
So what I love about self-directed IRAs is the fact that everybody is an expert in something, right? Peter Lynch talks about this. Invest in what you know. Now, what he was referring to was more traditional investments, like things that you buy, like you go to McDonald's every day, learn about McDonald's. That's what he was talking about. What we talk about is an extension of that. Let's say you're a professional real estate investor, and that's what you do day in, day out. You know real estate better than anybody else. Why would you invest in mutual funds? I mean, if you have a 401k somewhere and it's restricted to mutual funds, you have fewer choices. But if you're a real estate investor, you should be investing in real estate because that's where you're going to get your edge. And we all are looking for an edge with our investments. But if you're a real estate investor, why invest in tech stocks? Invest in what you know. So investing in your passion is along that lines. Because if you're passionate about real estate, then you're going to have a better risk to reward outcome than if you were investing in something you didn't know. And real estate's one example. We have clients who specialize in domain names, which is a weird asset class, or tax liens, or horses, or livestock, or farmland, or private company stock, whatever it might be. There are many creative ways to invest that you can come along with, that you can align with the way that And we were going to talk about at some point the creative ways to invest, but a lot of this is figuring out what you really enjoy and figuring out how we can craft an investment strategy around that.
Well, that begs the question when we talk about real estate investors. So let's say I'm a real estate investor and I have amassed a portfolio of rental properties that now is doing what it's supposed to do, and I don't have as much hands-on time. Can you convert that into self-directed through some type of transfers over time? Is that a strategy that can be implemented?
No. So you can't, there has to be a cash contribution to your retirement account. So what happens is if you have a real estate property and you want to put in your IRA, there's nothing you can do. So this question comes up a lot. It's a great question because what people want to do is take an asset they own and stick it in their retirement account and get that benefit. So you cannot facilitate a transaction from yourself into the IRA. That would be called a prohibited transaction. So you can buy it from a third party. You could buy it from your neighbor, or actually an exception to the disqualified person is a brother or sister, or a cousin, or an aunt and uncle. Those are exceptions, which are odd exceptions, but they can be very valuable if you have family members that you can work with. But generally speaking, you just have to be careful of that kind of transaction because there are some other rules around that.
And I can't let you go without talking about investing in a horse. What's that look like?
So we had a client who he runs a horse farm. So he basically buys horses from Europe, trains them, and sells them to really, really wealthy people with a lot of extra money. The New York types that just have obnoxious money to throw around. So what he does is, he buys the horse, he trains it, and then sells it. And so we found a way to do that inside of his retirement account. And he was making triple-digit returns from it because he knew how it worked. He knew the horse. He could strategize this. And this kind of gets into the whole strategy and the creative investing. And I'll tell you an interesting stat for your listeners that we all probably heard about Mitt Romney's $100 million IRA.
Yeah.
And that came out when he was running for president. It's public knowledge now. But the GAO did a study, I think it was maybe 10 years ago now, where they assessed retirement accounts and their size. There are 314 retirement accounts that are larger than 25 million. You want to take a guess at what the average balance of those 314 people are?
I have no frame of reference, Kirk. What's that number sound like?
$257 million is the average of those 314 people.
Holy
So
moly.
I know of a guy who works with one of them that is over $1 billion.
Wow.
So you don't do that by investing in Microsoft stock, right? There's some creativity that goes along with this, and it's all legal and above board. Because even if you do it right, you're still a target. So I have a good friend of mine who lives close by. He was targeted for a transaction that was completely legal, and the courts proved it that way. It had to do with the DISC. It was called a DISC investment. It has to do with foreign. I don't understand it all because he's an importer-exporter. But effectively, what he did was correct, and the IRA says, we don't think it should be allowed. Not it isn't allowed. It shouldn't be allowed. So, of course, we went to court and he fought it and he won. And now it's actually case law for this, which is really interesting. But the reality is you have to be really careful about what you're doing, and you can be creative, but it's like doing your taxes. You can really push the bar. The question is how big of a target do you want to be?
Yeah. So as we're almost winding up here today, a couple other particular assets that we want to talk about, alternative investments and Bitcoin. So are people putting Bitcoin into these type of things, and how does that look?
So Bitcoin is interesting because it's such a new asset, and we actually have an advisor here we brought on to focus on cryptocurrencies because we've had so much demand for it, and he specializes in it. So it's really, I'll say that it's so new that a lot of the law is still being crafted, and some of the processes are being worked out because no one has done this before. So there's some companies out there, some custodians that are specializing in cryptocurrencies and retirement accounts. And in our opinion, at least one of them is doing it incorrect. So we're very cautious about making sure we're dotting all our I's and crossing our T's. It is possible to do, but you get into the realm of who's going to hold the private key? How are you going to insure against that? What if there's a loss? So with a lot of the custodians, they're hesitant to allow it, not because they don't want to do it, just because they don't understand it. And they don't understand their own liability. Because what if someone steals the key, right? This is not a traditional asset in the sense that you can put it in a ledger. This is, hey, who holds the private key? Somebody could just run off with it, or they take the code and now all of a sudden they own the cryptocurrency. And how are you going to get back? These are all open questions that are being answered. We have clients that do it, and we have found ways to do it. We're just trying to improve our systems around it because it's as the cryptocurrency industry evolves, they're getting better and better tools that are more secure, and we're just we're trying to focus on people who are trying to make that a more seamless transaction.
Gotcha. And one last question about specific investment types. You mentioned you could use it to own companies and those type of things. Is that something that, with all the prohibited transaction rules and all that stuff, can somebody actually own a company of theirs in a self-directed IRA?
Yes and no. So inside, if you own a company, you're a controlling member of a company, and you're getting paid from that company, you cannot own that in your IRA. However, you can own it in your own company's 401k plan. So you can have if you own Acme ABC company, and you want to invest in your company stock, and you want to invest funds into the company, then you would buy stock inside the 401k plan, and that money would go into the company. So effectively, your 401k plan account would own shares or a percentage ownership of that company. And of course, they're treated like a traditional shareholder. That can be done. They're called Rob's transactions. There are a lot of people out there selling the concept that, hey, you can do this. But it is a very, let's say we're very careful about dotting our I's on that one, because the Department of Treasury issued a letter, I think it was 2008, that was really cracking down on those type of transactions. And they went after a few administrators that they believed were doing it incorrectly. So that has cleaned up a lot of the industry, but there's still players out there that do it incorrectly. So it's important to, I think there are maybe 2 or 3 attorneys in the entire country that we feel comfortable that understand this well enough to work with. I'm sure there are more, but we're only aware of a few because it's such a niche type of transaction that we want to make sure it's done right.
I will volunteer that I am not one of those attorneys. So that's about it for today. As I say, our promise of this show is to give you the information you need in 30 minutes or less. I do recommend that if you want any more information on what Kirk has talked about here today, to maybe subscribe to his Money Tree Investing podcast. Check him out at www.innovativewealth.com. And Kirk has also made a couple of white papers available for me to share with my listeners, so you can reach out to our office to get that link information. Or again, I think Kirk also has those on his website for you as well. So until next month, here is to your health, and look forward to chatting with you next month again on Third Thursday 30.